analysis. In TPM1, you learned tradable patterns that included entries, stops, and targets. Once in a trade, emotions can cause a trader to deviate from that method. Traders fear what they don't want to happen and are biased by what they do want to happen. Bar-by-bar analysis keeps them focused on what is happening. In addition, bar-by-bar analysis keeps traders focused on what is happening when they are not in a trade. Traders can become complacent when the markets are slow. By losing focus, traders can miss opportunity and become susceptible to chasing or entering an extended move. This typically results in losses or the wrong way to win. Let's see how bar-by-bar analysis works. Since patterns give us visual pictures of what others are thinking, we can look at each individual candle and put its message in the context of the current pattern. So we're always going to ask ourselves, what does the current candle tell us about the prevailing trend of bars or the prior bar? Each candle is going to give us information that's either going to confirm or contradict those bars and expectations of their meaning. Remember, long expanding candles tell us that volatility is high or momentum is increasing. Those are the wide range bars. Short or narrow range candles, or small candle bodies, tell us that volatility is low or momentum is decreasing. These are narrow range bars, narrow bodies, bottoming tails, and topping tails. Bar-by-bar analysis is going to incorporate candlestick analysis and retracement analysis. We're going to use retracements between the current bar and the prior bar. If a new bar retraces or gaps 60% or more into the prior bar, the odds increase that the original signal may be negated. At some point, a chaining of the guard, a topping tail, a bottoming tail, or a wide range bar will form, signaling a reaction in the opposite direction. That signal's potency is going to be determined by the trend, where it occurs, its depth in relation to the prior bars, and the market internals at the time. If it occurs prior to reaching support or resistance, or before the market internal signal change, is considered less potent. The correction suggested by the signal may be sat through. In other words, as prices are moving toward your targeted area, it's likely that you're going to see a bar that suggests a reaction against the prevailing move. We don't want bar-by-bar analysis to cause us to exit trades prematurely, so we want to put their messages in the context of the prevailing trend and the likelihood of prices reaching our targeted area. That said, we'll wait for the next bar to form and continually use bar-by-bar analysis to keep us objective as what's happening in the moment. In these next slides, we'll see how individual bars forming in the context of a prior pattern can change our thoughts and expectations about what's likely to happen next. In the current slide, we see all of the examples are closing above their opening price. So the current bar that's forming is the one with the dotted green horizontal lines. Now initially we have a buy setup, and it says the action requires a move above that bullish changing of the guard to enter. Once prices have traded above that bar, and you see the example in the middle on the left side here, we have a green bar that's closed near its high. It suggests prices are going to move higher, right? And we have a stop below the low. On the lower left, we see the current bar opened at or above the prior bar's high. In other words, a slight gap up. It closed above its opening price. It closed above the prior bar's high. The pattern suggests that prices are going to move higher, and we have no reason to think otherwise. On the upper right, we have a green bar that opens 50% or less, in other words, a gap down into the prior bar, and closes above the prior bar's high. Again, this is a bullish pattern suggesting that prices are going to move higher. While the gap down gave us some concerns, the move above the prior bar's high and close above the opening price was bullish. In our right side middle example, we have a green bar, in other words, it closed above its opening price, but it gaps down 60 to 80% into the prior bar. Now it also closed below the prior bar's high, so this is becoming questionable. While it closed above its opening price, which is positive, it could not take out the prior bar's high, but did recover from the gap down. So this bar puts the prior move in question. Lastly, on the lower right, you have a green bar that opens at or below the prior bar's low, a gap down of 100%, negative, and closes less than 60% into the range of that prior bar's range, which is the most questionable. So while it closed above its opening price, it had gapped down and could not retrace into the prior bar. In addition to these examples, I want you to imagine the last two examples if we were to make these bars topping tail bars. Right? This would become more negative. So while we're looking at individual changing of the guards here, if we were to put topping tails or bottoming tails on these bars, it would change the pictures additionally and give us other interpretation. In these examples, we have bearish bars closing. In other words, they're closing below their opening price or red bars. Well, once we've entered, and on the lower left-hand example, we have a gap up, but it closed below its opening price. In other words, a red bar. And what we do is look and see how far that red bar actually retraced into the prior bullish bar. It closed less than 50% into that bar's range, so this is still considered bullish. On the upper right-hand example, we see a bar that opens near the prior bar's high and closes less than 60% into that prior bar's range. In other words, an inside bar or neutral. And so we're waiting for the next bar to form, and ideally what we want to see is a bar that opens in the area of the prior bar's close, or even better, above the prior bar's high and closes above its opening price and takes out that bar's high. In our middle example on the right, we have a red bar that opens above the prior bar's close and closes at or below the prior bar's low. In other words, an engulfing bar, or what we refer to as a bearish potent reversal signal. Lastly, on the lower right, we have a bar that opens greater than 60% down into the prior bar's range, right, a gap down, and closes at or below that bar's low. This is very bearish. And just like in our other examples, if you can imagine any of these bars actually being topping tail bars, they would give you even a more bearish signal suggesting a move lower. Now with the examples on the right, the middle, and the one on the lower right, both of these are strong messages suggesting that your stop is going to be taken out. At this point, you have a decision to make. Do I exit the trade early, or do I wait for the stop to be hit? With these type of bars, odds are good if your stop is hit, you're going to experience slippage and you're not going to be able to exit at a point where you thought you might. And so there isn't a right or wrong decision to this. The bars are bearish, the trade is not working. Right? Personally, I would be exiting the trade with bars like this because the prior signal is being negated with a strong message. If, on the other hand, it had moved up higher and then suggested a move up from there, that would be a new signal by this prior bar being negated. Now we're starting with a sell setup. Once we have our sell set up and our bearish chaining of the guard, and we've entered below that bar's low, right, and we have that bearish bar starting to move down, right, this suggests that prices should move lower, and we've got our target above that high. On our example on the lower left, we have a red bar that opens below the prior bar's low. Again, all of these examples are closing below the opening price. Right, so in this one, we have a slight gap down. It closes below that bar's low and below the opening price. It's a bearish signal. Right? It suggests the pattern's going to go lower. We have no reason to think otherwise. In our example on the upper right, we have a bar that opens less than 50% into the prior bar's range. In other words, a gap up. It closes below that prior bar's low and below the open. We have a bearish bar. It's suggesting prices should go lower. In our middle right, we have a bar that opens 60 to 80% into the prior bar's range, or a gap up, but does not close below the prior bar's low. While it closes below its opening price, the gap up and the failure to take out the prior bar's low tells us that this setup is becoming questionable. We'll have to wait for the next bar to form to see what it tells us. Ideally, we'll have follow-through where it breaks down under the current bar and the prior bar and closes below its opening price, pushing lower. Lastly, with our example on the lower right, we have a red bar that opens at or above the prior bar's high, or gaps up 100%, and closes less than 60% into that bar. Right, this is becoming bullish. The size of the gap up, the lack of retracement into the prior red bar, tells us that demand is picking up. Now on the next bar, we need to see prices break lower under this bar and under the prior red bar. If it doesn't, right, this is telling us that buyers are continuing to step up, and the odds are that our trade is not working. This is the most questionable of the bearish setups. Staying with our sell setup, let's look at bullish bar scenarios. With the example on the lower left, we have a green bar that opens below the prior bar's low, or gaps down, but closes less than 50% into the prior bar's range, right, which is bearish, but it did gap down and close above its opening price, but it could not retrace far into the prior red bar. Now we have to wait for the next bar to see if it'll move lower and break this bar's low. With the example on our upper right, we have a green bar. In other words, it's closing above its opening price. It opened near the prior bar's close, but closes less than 60% into the prior bar's range. In other words, we have an inside bar and a neutral bar. We have to wait for the next bar to form, and based on our sell setup, we're looking for this bar's low to be taken out, and ideally a bar that closes below its opening price. In the middle right, we have a green bar that opens less than 50% into the prior bar's range, in other words a gap up, but closes 60% or more into the prior bar's range. This is now becoming bullish, and it's suggesting that prices can move up and potentially take out our stop. Lastly, we have a green bar that opens greater than 60% into the prior red bar's range, a gap up, and closes above the prior bar's high. This is very bullish, and the higher opening is more bullish. Now, with all of these examples, if we were to put bottoming tail bars on any one of them, that would increase the message suggesting that prices are going to move up. Now we're going to take a setup and build on that. As each bar forms in our interpretation of what's happening, as each new bar forms, it'll provide new thoughts about what's happening and project our thoughts as to what should happen in the future. As we go through this, I want you to think about this as if you were actually in the trade yourself and the thoughts that are being produced. And when starting out here, traders prior to the open are long and expecting prices to move higher. The pattern of a chaining of the guard and a bullish bar after that tells us the supply and demand relationship and that this is the case. Now as we move down here, at the open, traders are feeling confident. The first point of supply, meaning the prior bar's high, has been overcome. That's the dotted green line. And from there, traders are looking for prices to move higher. Now as it says, assuming a positive close, means closing above its opening price and above the prior bar's high, you'll have little reason to be concerned. Now as we move down, we see a red candle that's formed. Traders have seen for the first time supply overcome demand as our stock has closed below its opening price. The first or current point of demand now is the low of that red bar. So we have a chaining of the guard, a bearish chaining of the guard, suggesting that prices might actually move lower. Right? Our next reference point of supply is higher. So the odds suggest a minor retracement or possibly a time correction, in other words, a base. As you can see, what the odds suggest don't always happen. So while that red bar was suggesting some type of correction, either through time or price, we see it actually gapped up more than 50% from that bearish chaining of the guard. That indicates that demand is strong and overcoming supply. The fact that it closed near its high is an indication of strong demand and a bullish trend. Now, let's look at what's happening to our issue. Demand could not overcome supply, and supply was great enough to move that into the prior bar's range more than 50%. The range is also narrowed, so momentum is declining. Lastly, we see that supply is still overcoming demand, but a higher low is made. So we're beginning to see a base or a time correction that may be forming in a bullish trend, this suggesting that prices should move higher. We see our stock is gapped up 100% of the prior bar's range, which is bullish. Time corrections or consolidations after a move higher is bullish. Remember, the strongest stocks will create support where there is none rather than pull back and then move higher again. This is the essence of the late day breakout play that you learned in TPM1. This consolidation was the point of supply. So the uncertainty that was occurring during that base should now be over, allowing prices to move higher to the next point of supply. We see as prices moving up, the next bar starts from the prior demand point and never moves or retraces into the prior bar's range. This tells us that demand is very strong. This continues to the next bar, closing again near the candle high. And when the trades are working, textbook type patterns are the norm. Our last bar is unable to overtake supply. The prior bar is high. The range is also narrowed, indicating a loss of momentum. Odds are that now we're going to get another consolidation or possibly even a break of a prior bar's low. Let's review a chart setup that we would have considered and how we would interpret each bar as it formed after the setup. But let's first analyze what's happened and why we would have considered this as a trade setup, this breakout. Prices had moved up strongly prior to the consolidation. So the move up did create a price void underneath, so strong stocks will consolidate and build a new area of support. So as prices pulled back and formed new pivot lows, it then began to form new areas of support. On the right side of the consolidation, you see a bottoming tail bar that closed near its high. As it moved up and then consolidate, note the four bars on the right side of the consolidation. There's a green bar with a topping tail. There's a red bar with a bottoming tail. There's a more bearish changing of the guard. And then it's followed by a green bar closing above its open and near the high. That last green bar closing near its high signal that prices should move up above the consolidation, and this would tell us to buy above the high. Also notice that those four bars are consolidating at the top of the base. So rather than starting at the bottom of the base and traveling up through the top of the base to enter, in other words, a greater than 100% retracement, which would tell us to wait for a pullback, rather this consolidated near the high. So it was a positive pattern. Now, if we entered above the high on the breakout, we then begin to question the setup once the first bar ends. So as we see, the entry bar becomes a topping tail bar. This is not how you want to see a breakout close. Now, we have to wait for the next bar. The next bar could have been a bullish bar that took out the topping tail candle's high, which then would have alleviated the concerns we had because of the topping tail bar. But rather it formed a bearish changing of the guard. Right? Notice how deep does it penetrate into the prior bar. And it penetrates quite deeply into the topping tail bar. This is not ideal. Now, we're still in the trade, our stop hasn't been hit, and we're looking for that bearish changing of the guard bar high to be taken out. This would alleviate the concern of the prior pattern. It still doesn't happen. We get a narrow body bar, momentum is slowing, and it's in the lower half of the prior bar. Also notice it takes out the low of the bearish changing of the guard, which was our first reference point of support. Again, a stop hasn't been hit, and we're hoping at this point that a bullish bar would form and prices would begin to move up. What happens though is that a bearish wide range bar forms, igniting a move deeply into support. Now at this point, traders have a choice to make. Either exit this trade because it's broken below the breakout bar's low, which would be the proper thing to do for a short-term trader. Those with a longer-term perspective might have their stop below the bottom of the base. Now as prices move down to the bottom of the base, we see a bottoming tail bar form that's closing near its high. But also, the momentum is slowing, and it's in the lower half of the bearish wide range bar. So while there's stabilization, it's still not that positive. On the next bar, we see a red bar form. It actually gaps down from the bottoming tail bar and closes near its low. This certainly suggests that prices are going to move lower, but it is in an area of major support, and buyers should be down here. And what we see happen on the next bar is that there's a gap up, and prices close above their opening price and near the high of that bar. So as we combine the three candles now, the bottoming tail bar, the bearish bar closing on its low, and the gap up bar that closes up near its high, here is a message that prices should, if demand is strong, move higher from here. So those with a longer term perspective would have a pattern suggesting that prices should move up. If they don't, it's going to be a bearish pattern. Now what we see happen is that prices actually gap down. Right? It did close above its opening price, but we have a small topping tail. So the message continues that supply is overcoming demand, and this stock cannot move up. Lastly, there's a large bearish wide range bar breaking all support, and at this point there's no reason to be in this trade either from a short-term perspective or a long-term perspective. Now, as you get into a trade, note has the first point of supply been overcome? Are bullish bars being ignored? How far does the current bar retrace into the prior bar, and continue to question the setup bar by bar? In our next example, we see prices have gapped up and we're consolidating and then moved to a new high on the day. Now as prices moved up, our first reference point of support is going to be a prior bar's low. Notice that the topping tail bar, that's the potent changing of the guard, made a new high on the day and then traded under and closed below of the preceding bar that was the new day's high. This is never a good sign and suggests lower prices. The bars after that bar formed topping tails, which showed continued selling, while prices were stabilized near the low of that topping tail bar, the large red one that had made the new high on the day. When it tried to rally from there and recover, topping tails formed showing continued selling. Prices then broke down below those bars' lows. Again, that type of wide range bar moving to the downside creates a price void up above. But prices continued to consolidate where the candle bodies were at the bottom of that bearish wide range bar, indicating weak demand. Prices after that consolidation dropped again with another wide range bar to the downside. Again, the narrow bodies consolidated at the bottom of that bearish wide range bar. This was all falling within the price void that was below. Now as prices came down again, we see the consolidation begin to form, marked by those bars 1, 2, 3. Typically, you do not get more than 3 bars in a consolidation at the bottom of a bearish wide range bar before the next drop occurs again. As those bars began to form at the bottom of that bar, told us that demand was building. Notice the potent bullish changing of the guard after the red bar. Right? That red bar had no follow through, even though it closed on its low. Again, this tells us that demand was building. From there, prices had retraced up and then subsequently fell. I want you to notice in the middle of this range, the topping tail bar that broke out to a new high, right at the peak where the red arrow moves up and then moves down into a red arrow. There was a breakout that had failed and then started the selling from there. As prices moved down toward the prior low, note the bottoming tail bars that began to form, and then the attempt to move higher, which was followed by a potent reversal that closed below the prior bar's low. So there was a failed attempt to move higher, there was a void below, and prices dropped from there. Continue to monitor bar by bar. As already mentioned, bar by bar analysis is meant to keep you focused even when you're not in a trade. Starting at the lower left-hand side of the chart, notice the narrow bodies retesting the prior low. the bottoming tail bar, which broke below the prior candle's lows and then closed near its high. This tells you that demand is building and prices are likely to begin to move up. Also take note that the candle bodies that formed after that bottoming tail bar were at the top of that bottoming tail bar's range. Notice the topping tail that formed after that bottoming tail bar did not follow through to the downside. As prices moved up, a bullish wide range bar formed, starting to move higher. At the top of that bullish wide range bar, momentum was slowing and all the candle bodies stayed at the top of the bullish wide range bar. This signals that demand is strong and prices should go higher. Prices did continue to move higher, and as they did, we see topping tail bars begin to form, telling us that supply is beginning to overcome demand, but the trend is still up and bullish. Then a pullback begins, and a potent bullish changing of the guard forms, signaling a move higher. And we continue to monitor bar by bar, using retracement analysis between bars and retracement analysis between pivot points. As prices pulled back to the rising 20 MA, there was a narrow body, so there was slowing momentum, and then prices continued to push higher from there. Notice the topping tail bar after the breakout of the consolidation at the top of the slide. This was a short-term bearish signal. Prices had then pulled back and then retested that topping tail bar, forming a large M top with a topping tail and a bearish changing of the guard. As prices broke down, we see prices continuing to move down into prior support, but also creating a void above. Notice the weak reversal, the breakdown failure, and the potent changing of the guard, signaling that prices are likely to retrace. As prices did retrace, they moved up into the void and up toward resistance, but then sellers began to step up again. We see slowing momentum in that area, and then the break of a prior bar's low. Before continuing with the presentation, I'd like you to turn off the recording and look at this chart and review it, answering which each bar. Is it a wide range bar, narrow body, topping tail, bottoming tail, chaining of the guard? How significant is it? How far does the current bar move into the prior bar's range? Does a bar break a prior bar's higher low? Does a bar break a pivot higher low? Does a bar or group of bars suggest direction? Where would you put your short, long, stop, target? Once you've reviewed that, turn the recording back on and we'll review. At the start point, we see a red bar that made a new low on the move. Then prices gapped up, closing above that new low bar and closing near the high. This type of bar signals a move higher. While the trend was lower, this bar still suggests that there's going to be a retracement. The next bar was a wide range bar igniting a move up from a period of consolidation. Wide range bars create price voids but are strong messages that prices should continue higher. As a side note, you never want to see prices retrace back down to the bottom of a bullish wide range bar. Notice the two next bars stay in the upper part of the bullish wide range bar, and the second one is a bottoming tail bar that takes out the prior bar's low but closes near its high. That bottoming tail bar was a bearish red bar, even though small, but it recovered, signaling that demand picked up and prices should move higher. And that they did. Notice at the top a large bearish red bar forms, this signaling prices are going to move lower. Then we see a large bottoming tail bar. So there was an extreme amount of selling, but demand picked up in an area of support, pushing prices higher. The next bar was a red bar closing near its low with tails on the top and tails on the bottom. So we see some stabilization here. Our next bar is a green bar with a topping tail, and selling is still overcoming buying, but the battle is raging between bulls and bears at this point. Notice the next bar, the bottoming tail bar, takes out the low of the prior green bar and closes on its high. Whenever you see a bottoming tail bar, always question what did it look like prior to completion, and did it take out a prior bar's low or several prior bar's lows. These are strong signals suggesting that buyers are stepping up on a dip and prices should move higher. The bar after the bottoming tail bar is one in which it closes close to the high of the range. Right? These tell us that prices should move higher from there. Also notice that the high of that bar is close to the same highs of the prior bars. This was an area of resistance, and as prices began to move up, it took out that area of resistance, signaling that prices should begin to move higher. Prices gapped up and moved strongly up into the prior area of resistance, the prior pivot high, closing with a small tail on the top. The next bar momentum slowed down, had a small topping tail bar, but our first reference point of support is never overcome, the prior bar's low. The next bar closes near the high of the range, actually at the high of the range, suggesting that prices should continue to move up. The next bar does move up, closing up near the high, but now we have a greater than 100% retracement, and our retracement analysis says to look for a stall in the momentum. We get a bearish changing of the guard, breaking below prior bar's low, suggesting that prices should move down from there. But rather, we get another bullish wide range bar up, negating the prior red bar's signal. And bar by bar analysis keeps us in the moment and tells us what is happening rather than what was suggested to happen in the past. The next bar is a red bar consolidating at the top of the bullish wide range bar, which is a positive bar after a bullish wide range bar. And then prices follow through to the upside with another bar closing near its high, continued to follow to the upside, bar closing at its high even after a small gap down, and then right at the top of the move we see a bottoming tail bar, which is a narrow body bar telling us that momentum slowed down and then prices began to pull back from there. Now notice the green bottoming tail bar that breaks under the prior bar's lows. Right, this pullback is a type of PBS setup, but look at what happens after triggering above that bottoming tail bar's high. It forms a topping tail bar. So as prices traded above the high of the bullish bottoming tail bar, sellers overcame buyers and pushed it lower. The next bar again is a topping tail bar, this one closing at its low. Sellers are overcoming buyers. The stock is beginning to consolidate. We do not want to be holding a stock like this. This is signaling that the move higher is over and a period of consolidation is at hand. You'll find bar by bar analysis to be a very powerful concept. It'll keep your thoughts about what's happening based on what's actually happening, not on the past or what you'd like to happen. Once we place our money in the market, the wish to be right can cause a shift in perception. The shift causes traders to ignore signals to take profits or into holding on a losing position. Bar by bar analysis forces traders to read what's actually happening in that time frame. If they ignore it, they're ignoring valid information, not subjective indicators. If this information is still being ignored now that you've learned bar by bar analysis, the problem might be with the trader, not with the analysis of the market.